Hey guys, this is Stephen Hooley here, founder of Phoenix FXC. I'm just going to go through a really quick video with you guys on trading time frames. Now, time frames are pretty simple. You've probably heard of the 1 minute, the 5 minute, the 15 minute, the hourly, the 4 hourly, the daily, the weekly. And if you don't know what these are, that's okay. These are charting time frames that you can zoom in and out of the market, right? So let's go through this graphic real quick that you can find if you do a quick Google, right? Google search. Long-term traders are going to refer to the daily and weekly charts. The weekly charts will establish the longer-term perspective and assist in placing entries in the short term and the daily. Trades usually are from a few weeks to many months, sometimes years. This is really long-term. Now the advantage to this is you don't have to watch the markets daily or even weekly. There's fewer transactions, less time to pay the spread, the commissions don't matter as much. I mean, if you've got an 8 pip spread and you're catching 500 plus pips, you don't care about 8 pips, right? You're not going to care about the commission either. If you're paying $4 or $8 or $12 per standard lot, you can think about each trade and have a lot of time to do it. The disadvantage is it takes a lot of capital, takes a lot of patience. There might only be 2, 3, 4 setups a year. They're really good. And you could have a lot of losing months of some big drawdown. So just something to take into account. Now, if you go a little shorter term, do some swing trading. This is usually done on the hourly time frame, maybe the 4 hourly time frame. You're going to hold trades from several hours to maybe a week, right? There's more opportunities than super long term, less chance of losing, less drawdown sometimes. I mean, I've seen shorter term swing traders with tons of drawdown though, so don't, that drawdown's still a thing. You're going to have less reliance on just 1 or 2 trades a year to make your money, right? You're going to be able to make a little bit more money this way. Transaction costs are just going to be a tad bit higher because you're going to have more transactions, which means paying more in spreads, more in commissions. But really, when you're swing trading, those are usually covered pretty quick, right? And then you have intraday. So intraday can be anywhere from holding trades for several hours in a day and closing by the end of the day, or you're scalping the minute, right? Scalping is super short-term trading. So you've got the 1 minute, the 5 minute, the 15 minute. These trades, there's lots of opportunities for these, lots. And you're not going to be losing for months. You're not going to be holding drawdown for months if you're doing short-term trading correctly, at least. And there's no overnight risk because if you're scalping or intraday trading, you're not holding this overnight. You're not holding this over a weekend. You're in and out usually. The transaction costs are going to be much higher, but if you're catching a lot of pips, you're still making money. You just need to factor in the spread and the commissions for each and every trade you do, and that's really all. This is mentally more difficult though because you are constantly changing biases. You could be scalping up and then the next minute you've got to switch to scalping down. And, the next 15 minutes you've got to go back up again. It's taxing for some people. But more frequent profits, this requires less patience, and that's good for some people. So the point we're leading into here is that there is no right or wrong time frame. Don't let somebody tell you there's a right or wrong time frame. The right time frame is the time frame that fits your personality the best. I've seen traders kill it on the minute chart. I've seen traders who can't trade the minute, but they can trade the 5 minute and up. I've seen traders that won't touch anything less than the hourly. I've seen traders who won't touch anything less than the daily. I've seen killer swing traders, killer scalpers. I've seen it all, really. I've seen so many different ways to trade, and the important thing wasn't the time frame, it was which time frame matched their personality, which time frame were they comfortable with, which time frame could they trade profitably on, right? Then the other key things are, of course, the balance you have. That's going to dictate, you may like longer term, but if you don't have the balance for it, you're not going to be profitable on it. Shorter time frames mean you can use less margin of your balance, have less capital to trade, tighter stop losses, a little bit tighter risk. So that's something to think about, really. So let's show you some of the time frames so you can kind of get a feel. So right here, right, we'll start on the minute time frame. As you can see, this is a pretty small time frame, right? Notice this right here. This is a good marker, right? Notice this. Now, notice as we zoom in, or zoom out on the market, I should say, zoom out, notice what this becomes, right? Interesting, right? All of that extended out gets shorter. Let's go to the 15-minute. Now notice this whole thing. Let's zoom out further. Go to the hourly. It's just a couple of candles, right? Just a couple of sell candles. Zoom out even further. Just a couple of tiny candles, right? Just go to the daily. This is kind of, the daily is kind of, a lot of institutional traders will tell you, if you ever get the chance to speak to them, that the daily is kind of the base chart, right? You're either zooming in on the daily, going lower, or you're zooming out from the daily and going into weeks and months, right? You can go as far as weekly, look, bearish week, right? You can go to the monthly. Okay, so each one of these candles is a month, right? And on the weekly chart, each candle is a week. And on the daily chart, each candle is a day. And on the hourly chart, each candle is an hour. And on the minute chart, each candle is a minute. So that's how it works, right? So now you can see how, all right, on the monthly time frame, we can clearly see that uptrend, and then it reverses into a downtrend, and then it goes into another uptrend. So, I mean, you would have caught hundreds and hundreds of pips if you were doing this little uptrend, hundreds and hundreds of pips if you were doing this little downtrend, right? But you would have had to hold this trade for 1 month, 2 months, 3 months, 4 months, 5 months, forever. 5 months is a long time for a lot of people, right? Which is why a lot of people, a little bit too impatient, even the daily, you're going to have to hold this right here. Just to catch a sell right here, you'd have to hold this for days. Days. A lot of people don't like that. Some people have the patience. It just depends on your personality, right? You see a lot of swing traders using the 4 hourly. You can see this would have been 4 hours for each candle. Pretty decent sell, right? So this is what time frames are, guys. Just remember, capital is going to dictate what you can do. Mindset's going to dictate what you can do. Emotions are going to dictate what you can do. Personality is going to dictate what you can do. You just need to find the chart that you are most comfortable with in trading, most profitable with, okay? Simple as that. Now, thanks for watching. Let's move on to the next video.